You think you get to choose Coke or Pepsi, Apple or Microsoft. But what if the same three hidden giants quietly own them all? While the world argues about rival brands, a handful of shadow shareholders like BlackRock control up to 25% of every major company in America. This isn't just money, it's silent power, steering what you drink, buy, and even believe. But who gave them this reach? And what happens when competition is just an illusion? The answer starts with a disaster that nearly destroyed everything. Coca-Cola and Pepsi have battled for market share for more than a century. Their logos fill stadiums, their ads spark debates, and their flavors divide families. But behind the rivalry, the same names quietly sit at the top of both companies' shareholder lists. BlackRock owns about 7.2% of Coca-Cola and 7% of Pepsi. Vanguard and State Street, the other two giants in this story, own similar slices. Together, these three own a combined 25% of each company's stock. That means a quarter of every vote, every board decision, and every dollar of profit flows through the same silent hands. Apple and Microsoft are supposed to be fierce competitors, locked in a tech arms race that shapes the world. But the pattern repeats. BlackRock owns 6.8% of Apple and 7.1% of Microsoft. Vanguard and State Street add their own chunks, bringing the total to nearly 24% in both companies. The same three firms hold the largest blocks of shares in Google, Amazon, and hundreds of other household names. This isn't a conspiracy theory. Every number comes from public filings, hidden in plain sight. Index funds, like BlackRock's iShares, buy shares in every major company to track the market. Over time, these funds have grown bigger than the companies themselves. The result is a web of overlapping stakes, where the same few players have a seat at every table. They aren't running the brands you buy, but they have the power to sway decisions from behind the scenes. When board members are elected or policies are set, these giants cast millions of votes by proxy, shaping strategy without ever stepping into the spotlight. For most people, the illusion of choice still feels real, but the numbers tell a different story. It's not just soda or smartphones. The same pattern holds for airlines, banks, drug companies, and even news outlets. The more you look, the more you see the same names, repeating over and over, quietly steering the biggest companies on Earth. But this kind of quiet control didn't happen overnight. It started with a single disaster, and a man determined never to lose that much money again. A single name at the top of every company list might sound harmless, but the effect is anything but simple. When the same few giants own big pieces of every major brand, a strange thing happens. Experts call it common ownership. Instead of companies fighting tooth and nail for your money, their biggest shareholders quietly want them all to do well. If BlackRock, Vanguard, and State Street own a quarter of both Coke and Pepsi, does it really matter to them which one wins the soda war? Not really. What matters is that both companies keep making money, keep raising prices, and keep paying out profits. This overlap changes the game. Imagine a school where the same teacher grades every student. Suddenly, it's not about who's best, it's about keeping everyone happy and out of trouble. In the real world, this can mean less pressure to cut prices or out-innovate rivals. Studies have found that when airlines share the same top owners, ticket prices go up. The same pattern shows up in banks, drug companies, and even supermarkets. The illusion of choice starts to fade. These big funds don't just sit back and watch. They use their voting rights to shape company decisions. With a 15 to 25% voting bloc, they can swing board elections, approve mergers, and even set executive pay. They don't have to own half the company, just enough to tip the scales when it counts. Most of the time, regular investors never see how these votes are cast. It all happens through proxy voting behind closed doors, with the funds acting as silent referees. This kind of control is quiet but powerful. It doesn't look like a takeover. It looks like business as usual. But when the same few players can nudge the rules across hundreds of companies, the question becomes, who are they really working for? The people whose money fills the funds, or the managers who cast the votes? One thing is clear: when competition softens, prices can creep up, and companies can start to look more alike than ever. The lines between rivals blur, and the choices on the shelf start to feel a little emptier. But this web of ownership also comes with risk. When so much power sits in so few hands, what happens if something goes wrong? To answer that, you have to meet the man who built a machine to make sure it never does. October 1986. Larry Fink sat at his desk, staring at a screen filled with numbers. He was the rising star at First Boston, running a team that managed $500 million in mortgage-backed bonds. That morning, the bond market looked steady. By lunchtime, the world shifted. Interest rates spiked without warning. The value of Fink's bonds started to drop. At first, it was a trickle, then a flood. Phones rang non-stop. Traders shouted across the floor. The numbers on the screens turned from green to red. In a matter of hours, $92 million vanished from the books. Fink picked up the phone to call his boss. His voice shook as he delivered the news. They had been wiped out. Colleagues called it a disaster. Some whispered that it might end his career. For Fink, it was more than just a bad day at the office. It was humiliation. He had built his reputation on understanding risk, but one unpredictable swing had destroyed years of work in a single day. By the closing bell, the damage was done. The loss was public. The trust was broken. Fink was quietly stripped of his power. His team was broken up. The company moved him to an oversight role far from the action. For weeks, he replayed every decision, every number, every warning sign he missed. He knew he would never let this happen again. That day, the fear of losing everything became his obsession. He started dreaming of a way to see risk before it hit. A machine that could watch every number, every second, and never blink. In the middle of failure, a new idea took root. But at that moment, all Fink could see was red. And he wasn't the only one watching. In 1988, Larry Fink sat across from the partners at Blackstone, pitching a new kind of company. He wasn't selling confidence, he was selling doubt, a way to never get blindsided again. Fink had seen how one bad bet could erase everything. He wanted to build a firm obsessed with risk, a place where every dollar was tracked, measured, and protected. Blackstone agreed. They gave Fink and his team a $5 million loan and a $200 million line of credit. 7 partners joined him. Together, they launched a new business called BlackRock. Their first office was a small space in Manhattan, far from the marble towers of Wall Street. The desks were borrowed. The phones barely worked, but the idea was clear. Use technology to see dangers before anyone else. They started with just one client, managing $300 million. Every night, Fink's team ran the numbers, looking for cracks in the system. They built custom software, nothing fancy at first, just spreadsheets and mainframes. But each day, the system grew smarter. The goal was simple: never let surprise wipe out their clients' money again. Fink called it a risk management machine. BlackRock's first big win came when they caught a hidden flaw in a bond deal that everyone else missed. Word spread. More clients called. By 1992, they managed $17 billion. Fink's obsession with risk became the company's engine. The partners didn't chase headlines. They chased safety. If a deal looked too good, they asked why. If a model showed even a tiny chance of disaster, they pulled back. The firm's reputation grew. BlackRock wasn't just another money manager. It was a company built on fear, the fear of losing everything. Fink and his partners promised clients something no one else could, a way to see trouble coming before it hit. But as BlackRock grew, so did its ambition. Fink wanted more than just a risk tool. He wanted to build the world's smartest financial brain, and he was about to get his chance. The next step would change not just BlackRock, but the entire global economy. In 1988, BlackRock began as a handful of people squeezed into a borrowed office, surrounded by stacks of computers and tangled phone cords. Larry Fink's plan was simple but bold. Build a tool that could spot danger before it struck. The first version of their system wasn't fancy. It lived on spreadsheets and mainframes, running overnight calculations for a single client's $300 million. Each night, the team checked every number, looking for cracks that could turn into disaster. By 1990, BlackRock's software grew beyond simple math. More clients arrived, drawn by stories of near misses and last-minute saves. The team rewrote their code, moving from clunky spreadsheets to a networked system that could track thousands of bonds at once. They called it Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. It was like a brain for money, watching every dollar, every second. Early on, Aladdin caught mistakes that others missed. In 1992, the system flagged a risky bond deal that big banks had already approved. BlackRock's client pulled out, dodging a loss that hit the headlines days later. Word spread. By 1994, Aladdin was running on powerful servers, connecting to clients across the country. The platform could stress test portfolios, run what-if scenarios, and map out the ripple effects of a single bad trade. BlackRock promised something rare on Wall Street: safety. They didn't boast about wild profits or big risks. They sold peace of mind, backed by a machine that never slept. Aladdin became the backbone of BlackRock's business, quiet, invisible, but trusted to watch over billions. But as the system grew smarter and the numbers got bigger, a new question started to haunt the team. What happens if the brain ever goes dark? Aladdin now stands guard over a sum that almost defies belief. At its peak, the platform watched over $21.6 trillion in assets, more than the entire GDP of the United States and China combined. It is not just BlackRock's own money on the line. More than 200 of the world's biggest pension funds, insurance companies, and governments trust their fortunes to Aladdin's calculations. From Tokyo to Toronto, London to Los Angeles, the same digital brain scans portfolios for hidden dangers day and night. Every hour, Aladdin processes millions of trades and runs thousands of stress tests. It can model what would happen if oil prices crash, if a country defaults, or if a virus sweeps the globe. For its clients, that means a warning light flashes before a problem becomes a disaster. A pension fund in California, a sovereign wealth fund in Norway, and a bank in Singapore all rely on Aladdin to keep their money safe. The platform tracks stocks, bonds, mortgages, currencies, and even complex derivatives, assets that would take armies of analysts to monitor by hand. This reach gives BlackRock a window into the world's financial heartbeat. When a crisis brews in one corner of the globe, Aladdin sees the ripple effects before most people even notice. Its algorithms can spot patterns that hint at trouble, alerting clients to pull back or double down. But with so much power concentrated in one system, the stakes have never been higher. If Aladdin were to stumble, the shockwaves wouldn't just hit BlackRock. They could freeze trading, trigger panic, and send markets tumbling from Wall Street to Shanghai. The world's biggest investors depend on a single platform to keep their money and the global economy safe. But what happens if the brain that watches trillions suddenly goes dark? Aladdin is built to never sleep, never panic, and never miss a single warning sign. Every second, it scans markets across the globe, running thousands of stress tests and what-if scenarios. It can model the fallout if oil prices crash, if a government defaults, or if a new virus shuts down trade. Over 1 billion simulations run each day, all to answer one question: what could go wrong? BlackRock claims Aladdin has 99.997% uptime, meaning it almost never blinks. But even the smallest crack could be dangerous. The system is so trusted that a mistake, just a single miscalculation, could ripple through $21 trillion in assets. If Aladdin misreads a risk, thousands of pension funds, insurance companies, and banks could all move at once. A sudden 0.8% drop in value, triggered by a bad scenario or a software glitch, would erase more than $160 billion in a heartbeat. That is enough to spark panic selling, freeze credit markets, and send shockwaves through every financial system on Earth. Regulators warn about this hidden danger. They call it concentration risk, the problem that comes when too much power sits in one place. If Aladdin ever goes offline, even for a few hours, markets could seize up. Trading desks would have to guess at the value of their holdings, unable to get real-time answers. In a world where every move is tied to the platform's calculations, a blackout could trigger a chain reaction, spreading chaos from Wall Street to Tokyo, London, and beyond. Aladdin has survived every storm so far, but the more investors rely on it, the more fragile the system becomes. If the brain ever blinks, the world might find out just how much depends on a single line of code. And in that moment, even governments could be left scrambling for answers. March 2008. Wall Street was on edge as Bear Stearns, one of the oldest banks in America, started to crumble. Its books were loaded with toxic mortgage bonds, $30 billion worth, and nobody could agree on what they were really worth. The Federal Reserve and Treasury needed answers, fast. They called BlackRock, not Goldman Sachs, not J.P. Morgan, BlackRock. The government handed over the Bear Stearns portfolio and gave them just 48 hours to figure out how bad the damage was. Inside BlackRock's offices, teams worked through the night, combing through thousands of contracts and spreadsheets. Every number had to be checked, every risk mapped. The stakes were clear. If they got the value wrong, the entire rescue deal could fall apart. BlackRock's risk machine, Aladdin, ran scenario after scenario. It modeled what would happen if home prices kept falling, if more loans defaulted, if panic spread. The numbers didn't look good. Billions were at risk, and time was running out. But by the end of the second day, BlackRock delivered their answer, down to the last decimal. The government used their numbers to backstop the deal, and Bear Stearns was sold off to J.P. Morgan for pennies on the dollar. The speed and accuracy stunned everyone. In a crisis where every second mattered, BlackRock was the one trusted to hold the calculator. This was more than just a one-time job. BlackRock's performance during those 48 hours earned them something far bigger: trust from the most powerful people in finance. Soon, they weren't just valuing portfolios. They were writing the playbook for how to handle toxic assets, setting the terms for trillion-dollar bailouts. Their contracts with the government kept growing year after year. Each new crisis made BlackRock more essential. Banks, regulators, even entire countries now depended on their judgment. But when one company becomes the first call in every disaster, a new kind of risk starts to grow. What happens when the referee becomes the player and nobody else knows the rules? BlackRock's job as Wall Street's emergency plumber didn't end when the storm passed. After the Bear Stearns rescue, the U.S. government kept coming back. Each new crisis brought another call, another contract, another chance to steer the system from behind the curtain. BlackRock's role grew from fixer to permanent gatekeeper. By 2020, when the world locked down and markets crashed again, the Federal Reserve skipped the usual bidding process and handed BlackRock the keys to a new rescue program. No questions, no competition. They were paid $150 million in fees to buy bonds and manage assets for the Fed, all while running the same kinds of funds for their own clients. The lines blurred. BlackRock was now both player and referee, making decisions that could move markets in their own favor. Congress finally pushed back. In 2022, lawmakers dragged BlackRock executives into public hearings, demanding answers about their growing influence. Senators questioned why one private company could act as the government's right hand in every emergency, with almost no oversight. Critics pointed to the stress test contracts that kept getting renewed year after year, cementing BlackRock's place at the heart of the financial system. Even when the immediate crisis faded, BlackRock's advisory role stayed. The Fed and Treasury kept leaning on their expertise, their data, and their algorithms. BlackRock's advice shaped which banks passed stress tests, who got bailouts, and how much risk the system could handle. Defenders argued that BlackRock's size and technology made them the only real option. But behind closed doors, officials worried about the risks of letting one company become too important to fail. BlackRock's reach now stretched from the trading floor to the halls of power. They didn't just manage money, they shaped the rules, set the boundaries, and watched over the entire game. The government's dependence on BlackRock had become a permanent feature, not a temporary fix. But the true cost of this partnership wouldn't show up on a balance sheet. It would hit ordinary people in ways they never expected, starting with the place they call home. In the years after the financial crisis, A new kind of buyer started showing up at suburban open houses. Not a family with kids, but a faceless fund with billions to spend. BlackRock, through its real estate arms and investment funds, poured money into the American housing market. Instead of buying homes one by one, they bought entire neighborhoods in bulk. By 2025, BlackRock's real estate funds managed assets worth over $25 billion, putting them among the largest players in the market. Their reach stretched across the country, but some cities felt it more than others. In Atlanta, for example, BlackRock-linked funds and similar giants controlled about 7% of single-family rentals, enough to sway prices in whole zip codes. Nationally, BlackRock's share hovered around 5% of all rental homes, a small slice in percentage terms, but a massive number when you count the millions of houses in play. The numbers grew quickly. In hot markets like Phoenix, Dallas, and Charlotte, institutional investors, many with BlackRock as a top shareholder, snapped up homes faster than locals could make an offer. They paid cash, often above asking price, outbidding families and first-time buyers. Some funds sent automated bids within hours of a listing, turning the dream of home ownership into a race that most people couldn't win. In 2023 alone, institutional investors bought more than 15% of all single-family homes sold in the United States. BlackRock's funds didn't buy every house directly, but their money powered the trend. They held stakes in companies like Invitation Homes and American Homes for Rent, each owning tens of thousands of properties. Every purchase added to a growing pool of rentals controlled by Wall Street. For families trying to buy, the rules changed overnight. Instead of saving for a down payment, many found themselves forced to rent from a corporate landlord. Rents climbed as competition disappeared. In some neighborhoods, over a quarter of homes were owned by just a handful of big funds. With billions in backing, these firms could afford to wait out the market, holding properties empty until prices rose. The old idea of owning a home for life began to slip away. The scale of BlackRock's influence was no longer just a number on a spreadsheet. It was a new reality for millions of Americans. But behind every statistic is a family, a story, and a question. Who really gets to call the suburbs home? The answer starts to take shape when you follow one family's search for a place to live. A new kind of report card now rules the corporate world. It's called ESG, short for environmental, social, and governance. On paper, it sounds simple. Companies get a score based on how green they are, how fair they treat workers, and how well they follow the rules. But when BlackRock holds the pen, that score can become a chain. With $3 trillion in ESG-linked funds, BlackRock is the world's biggest enforcer. Their analysts set the bar. A score of 70 is the unofficial line between safe and risky. Fall below, and the punishment is swift. The numbers tell the story. In 2023, a single energy company watched $500 million vanish overnight as BlackRock and other funds dumped its shares after a poor ESG report. The message was clear: fix your score or lose your lifeline. For companies, a low ESG grade doesn't just mean bad press, it means higher costs. Some saw borrowing rates jump by 12% after a downgrade, wiping out profits and forcing layoffs. Bankers quietly admit they check BlackRock's ESG ratings before approving big loans. If the score is too low, the answer is no. the pressure isn't just on oil or coal. Fast food chains, tech firms, and even real estate developers now scramble to please the ESG gatekeepers. At BlackRock's headquarters, the chief ESG officer reviews reports from over 10,000 funds, scanning for weak spots. Each year, the rules get tougher. Companies add climate plans, diversity targets, and new policies, sometimes just to keep access to BlackRock's billions. When a CEO asks why their stock is dropping, the answer is often buried in a single number on an ESG dashboard. Some call this progress. Others see it as quiet blackmail. The threat is always there. Improve your score or risk being cut off. Behind every ESG downgrade, there's a boardroom in panic, a phone call from a bank, and a scramble to fix what's broken. The power of one rating set by a handful of people now shapes the fate of companies around the world. But what happens when the rules change overnight, and who decides what counts as good enough? Right now, one company's algorithms quietly help steer the fate of nearly $14 trillion, more than the gross domestic product of China. As financial power centralizes, ordinary choices shrink, and the invisible lines between influence and control blur. Our world runs on code and quiet decisions, not public debate. In the end, the real question isn't who owns what, but whether anyone is truly watching. Share your thoughts below.